What is fundamental analysis? What factors affect it? What is fundamental analysis? In all financial markets, both traditional and emerging markets such as crypto, there are several general methods for analyzing the market situation and deciding to buy or sell, one of the most important of which is fundamental analysis. In this article, we define fundamental analysis and compare it with other types of analysis. In other words, in fundamental analysis, the analyst examines and analyzes the conditions of a project or company from different aspects and follows its important news and events. Analyzing all aspects and factors affecting a project or company in order to identify its intrinsic value and potential is known as the definition of fundamental analysis. For example, if the news of Bitcoin acceptance is published by Amazon and someone thinks that the price of Bitcoin will rise and buy Bitcoin, she has actually used some kind of fundamental analysis to decide whether to buy Bitcoin. Types of analysis used in financial markets. In financial markets, in addition to fundamental analysis, two technical analyses and sentiment analysis are used. In technical analysis, the price trend can be predicted using the price history of a commodity, stock or currency, as well as by using various indicators. In this type of analysis, to evaluate the market, we only need to study the movement of prices and do not consider any other criteria. Sentiment analysis also uses various tools to examine and analyze the dominant feelings of people in the community towards that service or platform. This type of analysis is very similar to fundamental analysis. Using different tools in investments can reduce the investment risk and increase the probability of the investor's success. What is intrinsic value? One of the main assumptions of fundamental analysis is that the current stock price often does not reflect the value of the company that is available through public data. The second assumption is that the value reflected from the firm's core data is likely to be closer to the true value of the stock. Analysts often refer to this hypothetical real value as intrinsic value. It should be noted, however, that the use of the term intrinsic has a different meaning in valuing stocks than it does in other contexts, such as options trading. Standard pricing for intrinsic value is used in pricing options. However, analysts use a variety of complex models to arrive at the intrinsic value of a stock. There is no single, generally accepted formula for achieving the intrinsic value of stocks. Why should we use fundamental analysis? Understanding fundamental analysis is essential to determining the correct market valuation of stocks. Analysts often look at macro and micro factors to identify stocks that are traded at prices higher and lower than their true value. If a stock is not priced properly, it can have more monetary value and higher profits. This is especially true in cases where the value of the stock is valued below a fair price. What is the difference between fundamental analysis and technical analysis? Fundamental analysis relies on company parameters. Technical analysis, on the other hand, considers only price changes and past price data. Investors perform technical analysis on the chart. The purpose of technical analysis is to make assumptions based on past stock price performance. Pure technical analysts do not trust the company's data and foundations. They analyze charts and try to find patterns for recognizing future behaviors. Technical analysis may seem illogical. However, there is a strong psychological relationship between price changes and the psychology of market participants. Because stock prices are determined by supply, sell, and demand, purchase, stock price milestones are likely to influence market participants' attitudes. What are quantitative and qualitative fundamental analysis? Quantitative fundamental analysis. Quantitative fundamental analysis refers to information that can be expressed in quantitative numbers and quantities. Quantitative foundations are measurable features of a business. For this reason, it is the largest source of quantitative data for financial statements. Income, profit, assets and other items can be measured very accurately. A financial statement is an intermediary by which a company discloses information about its financial performance. Fundamental analysts use quantitative information from financial statements to make investment decisions. The three most important financial statements are the profit and loss statement, the balance sheet and the cash flow statement. The important parameters of quantitative fundamental analysis will be introduced below. Qualitative fundamental analysis. Qualitative fundamental analysis is about nature or standards and is not numerical. Qualitative foundations are less tangible. This fundamental analysis may include the quality of a company's key managers, brand identification, patents, proprietary technology, and so on. The following are important quality foundations that should always be considered for any company. Business model. What exactly does the company do? Business model is an important parameter in fundamental analysis. Competitive advantage. The long-term success of a company is mainly due to having and maintaining a competitive advantage. Strong competitive advantages, such as branding and market dominance, are like building a moat that keeps competitors away from companies that own them. When a company can achieve a competitive advantage, its shareholders can make a good profit for decades. Management. Some believe that management is the most important criterion for investing in a company. This statement is logical. Even the best business model is doomed to failure if company leaders fail to execute plans properly. Although it is difficult for small investors to meet with managers and actually evaluate them, it is possible to check the records of board members by visiting the company's website. Corporate governance. Corporate governance reflects the policies implemented in an organization and expresses the relationships and responsibilities between management, managers, and shareholders. These policies are defined and determined together with the rules and regulations of the company in the company's articles of association and its bylaws.